Private investments are in the headlines more and more with massive investments in hard assets and infrastructure.
These assets, many of them, need to exist and need to serve society, regardless of whether you have economic expansion or contraction.
So what do investors need to know?
We all like high returns. However, one always has to understand the correlation between returns and risk.
TD Asset Management's Colin Lynch believes that means hands-on active management.
You have to go and walk the asset. You have to understand the asset. And that's what we call due diligence. We're owners, we're operators, we're managers.
The Money Talk Podcast, brought to you by TD Wealth with Kim Parlee.
Hi, everyone. Thanks for joining us. We have a great conversation today. We are delving into private assets, really trying to get a primer on what they are and what an investor needs to know. I'm here with Colin Lynch. He is Managing Director and Head of Alternative Investments at TD Asset Management. It is lovely to have you here.
Well, thank you for having me. I'm very excited for this conversation.
Yeah, it's, you know what, and I'm hoping you're going to school me as we go through this, because there's a lot of things I think notionally people understand what this is, but I don't think maybe they appreciate the depth I know that your team has and just how it all works. So I'm hoping we get there. So let's start with the basics.
Sure.
What are private investments?
They're investments that are not publicly traded. They include for us at TDAM, real estate, infrastructure, private credit, and commercial mortgages. And I think the private markets name is really accurate because we're not publicly traded. We're not talking about publicly traded investments, which are your stocks and bonds. These are other things that are not publicly traded on an exchange. So what are some of those things? Those are the things that we live in, we work in, buildings. These are some of the companies we work at that aren't publicly traded, that need to borrow private debt. This is the heat and energy that we use, the electricity that we consume, how we get about our cities, how we get between cities. So transportation, energy, these are some of the hospitals. That's in the broad world called infrastructure. And then back to the live, work, play dynamic in terms of buildings, we also use debt to build buildings or to actually own buildings. And so it's commercial mortgages. So put differently, it's an exciting world because it's a world that we live and inhabit every single day. And it's been around for generations, actually since the beginning of civilization. But it has not historically been broadly accessible because it hasn't been publicly traded.
And is that the real reason it wasn't broadly accessible? Is it just was not something that a retail investor had access to?
Yeah, so I'm a student of history. I love history.
Yeah.
If you go back thousands of years, these investments, assets, properties, were held originally by governments. So they're run by governments, run by rich individuals. So if you go back to ancient Rome, there was an entire class of individuals that would have owned the property and provided the loan capital to different entities, etc. Not broadly accessible. Move forward through the Renaissance, and as we moved into bigger and bigger cities, who owned a lot of these investments? Again, governments or different, whether it was members of the royalty, very rich individuals.
Yeah, concentrated, right?
Concentrated.
It's very concentrated, yeah.
And that has been broadly the case all the way into the 20th century. And in the 20th century, you had a class of investor come about called institutional investors. And those institutional investors were pension plans. They were endowments and foundations, and they managed to get access to some of these investment classes because of diversification, the ability to have different return profiles, and so thereby not just have access to a broader universe of things to invest in, but also by virtue of having access to that broader universe and having investments that behave differently, be able to reduce the volatility of a portfolio. So that's institutional investors, and that was a real 20th century innovation. But as we move forward into the 21st century, we have now created structures and mechanisms, and actually we've seen evolution in the industry, i.e. some of the participants, to say, hey, This is not just relevant to big institutions who, by the way, serve individuals, i.e. a pension
Yeah.
is just a mechanism by which many people are able to fund retirement.
Yeah.
But why don't we actually help many of those individuals that may not be able to participate in a big pension? They might be entrepreneurs that have to fund their own retirement, right? They might be individuals that wish to save for something in the future, might want to pass an inheritance to members of their family. And so these investments that have been around for generations are worthwhile for them as well.
If just at a very basic level, we talk about return profile, and I've talked to you for years. You are incredibly deep and sophisticated in what you do, and I'm going to try and make this really basic. It's the public equities are something that are available. Anybody can buy and sell public equities if they have it. The bond market is public, a lot of it, but these are. This class of investments that, again, were not available to, I'll say, the regular retail investor. And we're talking trillions of dollars here, right, of assets that, and you talk about a different return profile. Just maybe tell us what that means. Why do I care? Why do I care as a different return profile?
Yeah. Foundationally, these assets, many of them, need to exist and need to serve society, regardless of whether you have economic expansion or contraction. So, if you have a recession, the stock market might adjust accordingly, and one might see that in your returns.
Right.
If you have a recession, you will still likely need the energy. And so, if you step back from that and just think more broadly, we call many of these investments essential. We feel it, and it really hurts if we don't have them. If the airport goes down, it's a problem. If the electricity goes down, it's a problem. If we lose access to an apartment building where 400 families are living in, that's a big problem. And because of that, these investments have to produce. They have to serve the consumers that use them every day. So having some of that income stream in your portfolio helps to offset some of the volatility that might be experienced through other investments.
But there are some, I'll say, truths about the private market that people need to be aware of too. And maybe we can
100%.
talk about, what are they suitable for? What are they not suitable for? And maybe what are the misconceptions about them right now?
Yeah, and I can go on at length, but let's talk about a few. First, liquidity.
Yeah.
Private markets are not public markets. And by virtue of simply that, one is not able to, on Monday, say, hey, I'd like all my money back, and on Tuesday get it. Why? Because it takes time to sell a company, it takes time to sell a building, it takes time to sell portions of loans. It just takes time. So any notion that says your liquidity is going to be the same as your stock and bond portfolio, that is incorrect. And so therefore, investors really need to think about what portion of their portfolio should they have exposed. Certainly an attractive space, but for many people that actually need access to the cash next year, or you need a rainy day fund, I would submit you don't invest your rainy day fund in private markets because by definition, they are less liquid.
Yeah.
That's one. Number two, the private markets have many larger-than-life personalities, and they have built big programs and big platforms, and those personalities collect very high fees. And some of those fees are apparent, some of those fees are beneath the hood, and they're fees on fees on fees. And it's really, really important to really understand what are the fees and the full stack of fees in whatever you're investing in. And that is especially important for retail investors. The third has to do with this search for high returns. We all like high returns. However, one always has to understand the correlation or the trade-off between returns and risk. In the debt space, a high yield investment is typically high yield for a reason.
Yeah, it's priced for risk.
And so many people with strong personalities get taken in by, hey, I can get this 12% yield. Well, one has to really understand what is driving that yield to be so high. understand what is the quality of the underlying loans that are being made, and what is the chance that those loans go sour if something happens. And many folks don't do that. They focus on
The return. Yeah.
and so this concept of return and risk is important in all investing, but I'd say even more so in the private markets, given there's less liquidity. And many people just ignore the risk, focus on the return. When something happens, when there's defaults, when the fund is unable to meet liquidity requirements, then we hear about it. And it's just important to remember liquidity is different. Note the personalities, understand the full fees, and understand the relationship between risk and return.
It's a great primer. I think it's so. Anyway, it's a really great primer just to say to give people understand the total landscape and where we're going. And I think one thing that I'd like to do is walk through a bit of when you think about TD Asset Management and what you do. We can talk a bit about the sectors that you focus on, your due diligence because this is actively managed, and we'll talk a bit about that, and then some examples, right? So people can understand why these are compelling businesses. There's a lot of folks who offer private investments to investors, but they may, for example, take out a piece of what they manage and outsource it to others. Where you are, when I say you're active, like, can you give me, for people who may not understand what active management means in this space, what does it mean for you?
Yeah, so that's a great question. There's two components to that. One is, do you directly own, or effectively is somebody else directly owning and you're sort of investing in a fund that they're running?
Right.
We're fund managers. And our job is to make the acquisition
Of an asset.
Yeah. And I'll talk about how, but make the acquisition, to run the asset, to deliver good performance and income, which at the end of the day is the fundamental basis by which value is created. And then to dispose of that when the time comes to create value in the disposition. Those are the three things. Now, how do you acquire well? And that's critically important. We like to use a word called bilateral. You could also think off-market. So what do I mean by that?
Yeah.
So think about if you're an individual and you're going out to buy a house. You can, in a competitive market, receive all the listings. You can hire a real estate agent, and the real estate agent can get the listings from other real estate agents. And you could go into the open house, you could see the 30 other people there, and you can throw in your bid.
Yeah.
And you might win.
Yeah.
After you might put in a bid and then
After you
re-up your
bid
bid,
up. Yeah.
and et cetera. And the question is, did you actually win? Because you're the highest priced buyer.
Yeah.
And everybody else didn't see as much value as apparently you did.
Right.
So that's one way of buying things. Another way of buying things is to say, oh, a friend of a friend is actually looking to sell a house. And because they need to sell it really quickly, or they don't want to go through the trouble of having a lot of people go through their house in an open house, they're willing to sell it to somebody who's a friend of the friend. And they know they might not get the best price, but they can do it really quickly. They sell it to somebody that they implicitly know through their other friend. And so therefore, you're able to negotiate and come up with something that works for both parties. We call that bilateral. And in the infrastructure space, the real estate space, the credit space, those transactions tend to create a lot of value because you're not overpaying potentially
Right.
for an acquisition. So your basis, i.e. the price by which you have entered something, is attractive.
Yeah.
Then, what do we enter? Well, we might have bought some assets in the infrastructure space. We might create a management team. That management team might hire staff. We'll create a board. And we'll say, that's wonderful. Let's run these assets really well. But let's not just stop there. Maybe we can create more value by doing other acquisitions in the same bilateral sort of way. And because we are creating bigger and bigger platforms, we're able to run these investments more efficiently. Not just that. Let's say it's an energy company and it produced energy. Well, guess what? You can now store energy after you've produced it, and you could sell it
So
at
these
opportune
complete
times.
verticals you're thinking of, yeah.
Exactly. You can expand throughout the value chain of whatever it is that you're doing, and you could create value that way. And then let's say it's time to dispose. Well, we can dispose of it in an emergency way, i.e., we run a fund and we have to sell the fund's time, closed-ended funds, and there's different types of funds. Open-ended, which are perpetual life, and closed-ended, where they have a time horizon. Many private market investments are done in closed-ended funds. And so when the time comes to end the fund, they have to sell.
Yeah.
And so therefore, they're in a rush. And if you've sold your house and you're in a rush, you almost know you're not going to get top price because you're in a rush.
Yeah.
So similarly, how you sell matters. And so we like selling with a broker, having lots of people. Think about that open house. And they come through and they compete against each other. They bid up the price and we get top price.
Right.
So the three components, we buy well, we manage really well, and we sell well, is how we create value for an asset. And then you look at the portfolio. How do these assets perform with the other assets in the portfolio? How do their returns offset each other? What's our exposure geographically? What's our exposure along every sort of, whether it's in real estate, the retail, the office? What type of retail? Is it a super regional shopping mall? Is it a mall that's along a street like Yonge Street, et cetera? They perform very differently, even though they're retail. All of that is what we call portfolio management. And so the full spectrum is how we actually generate returns. We're owners, we're operators, we're managers, versus we've created a partnership with somebody else and it's over to them to do that.
They handle the allocation that is private. It's interesting too, because what I'm hearing is like you're optimizing for the economic life cycle of the asset.
Yes.
Without the handcuffs of and I'm sure there are some handcuffs that come up sometimes with some things, but what you're trying to do is just optimize the economic value of the asset and getting
Yeah.
it in it when you can.
And we think that's aligned with investors.
Yeah.
So historically, most private markets funds are close-ended.
Yeah.
You have a couple years to raise money. You have a few years to invest. You have a few years to manage and harvest and wind up the fund. Overall, that's roughly a decade. But if you go back to the beginning of our conversation, I just talked about assets that have been, investment classes that have been around for as long as we've had civilization. I've talked about things that are completely essential to our society, things that live, work, and play. When you build a big office tower, is it around for 10 years? No. If you have a power company, is it around for 10 years? No. And so we think foundationally, the investors' interests are better aligned with structures that serve those interests. And an open-ended perpetual fund is very aligned with not just investors' interests, but also with the assets that the fund is investing in.
It's maximizing value, right?
Yes.
That is the intent. It's a great explanation, and I'd love to now just dig into some of the sectors and some of the examples, because I think it really comes to life in that. So let's start with infrastructure. It's
Yeah.
always a fun one. What are the kinds of things that go into infrastructure, and then how do you do your due diligence to decide? And I know it depends on what asset you're talking about, but how do you choose? Like if you have
Yeah.
a port, if you have this, like how do you decide that's good because of this?
Yeah. So what goes into infrastructure? I mentioned energy. So
Yeah.
there's energy production, storage, transmission. There's transportation.
Yeah.
So you could think transit within a city or transport between cities, like a port, an airport, railway. You have social infrastructure like hospitals,
Yeah.
social housing. And it sounds like real estate, but it really depends on who your customer is. If the customer is the city on a long-term contract, that's more like infrastructure, versus your customer being the renter who's
Right.
renting on a one-year basis. It's more like real
It's
estate.
the business in the real estate versus just the real estate. Yeah, yeah.
Exactly.
Yeah.
And then there is also digital infrastructure, so data centers. And there, too, that is on the boundary of real estate versus infrastructure. But there again, it is who's the nature what is the nature of the customer?
Yeah.
So is the customer doing a 20-year deal? Is it really related to the energy in the data center, et cetera? So in the infrastructure space, those are the main verticals. And then how do you determine whether something is a great investment?
Yeah.
So a lot of pieces, but it's really fun. So one is there's always financial analysis. Anything one does, and I'm going to say whether you work in an investment firm or whether you're buying a house, you should always run financial analysis, your own, not somebody else's. And when you do so, you create your assumptions, the ones that you believe in, i.e., so if it's an airport, okay, how many passengers go through that airport every year? How many planes land? Those are two big drivers for revenue. Planes pay landing fees and gate service charges. Passengers have passenger airport improvement fees. You forecast those out based off of something. What's economic growth?
Yeah.
What's the level of attractiveness of the airport? Does it compete with other airports or not?
Yeah.
Can you attract additional airlines? How much they have to invest to do so, et cetera? Lots of assumptions, right? Then you have the expense profile, right? The airport has to be cleaned, it has to be serviced. You have to build new parts of the airport to attract new airlines, et cetera. That's capital expenditures. That's a cash flow item, et cetera. So you forecast all that out over at least a 10-year period. And then you discount that back to the present. You compare to the price that, in effect, and I'm simplifying, but you compare it to the price that the seller wants. And then you look at that and is it worth it or not, right?
Yeah.
Is your value higher than what you're going to pay? How much so? And then you compare it to other investments you might be able to make.
Right. So opportunity cost.
Exactly.
Yeah.
So that's one thing. That's numerical. But you have to go and walk the asset. You have to understand the asset. You have to inspect the asset. And you have to hire people to do that with, for instance, if you're buying a building, what's the roof condition of the building? What is the window conditions of the building? Same thing with an airport. What's the roof condition of the airport, the window conditions of the airport, et cetera? So you have to do that. And you have to hire people to help you do that. And that's what we call due diligence. There's also a lot of legal due diligence. So if there's lawsuits, different
Outstanding
things,
claims, you never know.
et cetera.
Yeah.
It's a long process. And it could take several weeks. It could take several months to complete. It gets really, really fun, actually, the shorter time that you have.
Yeah.
Because usually that means that there's an opportunity to get something at an interesting price because the seller needs to move very quickly.
Yeah.
And then also, you on the investment team have the opportunity to look through and to do all that due diligence really, really quickly as well. And so you cover a lot of things. I didn't even mention the people, the management team, the staff, et cetera. It's multifold, but it's very detailed, very intense, and it's usually on the ground. And it involves a lot of people, not just on the investment team, but the lawyers, environmental consultants. You might have HR consultants, et cetera, that will give you advice on that investment opportunity.
It's just, the due diligence that's required for this is next world. I think for a lot of people understanding this, but I want to ask you as well, because let's go through on Infinite.
Yes.
Which is, well, you tell me who they are. They're in Alberta.
That's right.
Yeah.
And they're an incredible company. They are 100% owned by our infrastructure fund. They produce power.
Yeah.
And so when we acquired Infinite, we acquired power production facilities, and we rolled them into a common platform and called it Infinite. But then we expanded that to storage. And if we think about Alberta, Alberta has a number of what we call critical grid alerts, where there is just simply not enough power to go around for the demand. And these battery packs provides that energy to the province, and we have 95% share of that operating energy provided by backup power to the province in Alberta. And so that's exciting. We're in the midst of expanding Infinite further. So it's not just in Alberta now, it's also in British Columbia, And over time, we expect to expand this right across the country. And we're working on that right now.
So great. Silicon Ranch. And this is, where's this one based?
Yeah, it's based in Nashville, Tennessee.
Oh, okay.
Wonderful place to visit.
Yeah.
So it was the first investment in the infrastructure fund back in 2014. And when we invested, just to give you a sense, $20 million was the investment we made. Roughly just over 50 megawatts, which just a unit of measured power. Today, investment is worth over $1 billion. And the production is just over 4,000 megawatts. And we have just about the same amount in development.
Wow.
It has grown spectacularly. And it's grown spectacularly for similar reasons on Infinite. We have a great management team. It's solar farms.
Yeah.
We started with a couple locations. Now we have hundreds across the majority of U.S. states with the potential to do more. We serve customers who are local governments who sign power purchase agreements that are decades long each, or with some of the big global names we hear about every day, like Meta. And why is this really interesting? Well, we are in an environment of dramatic growth in energy requirements because we have AI, we have data centers, we have more connected devices, et cetera, and all of that is growing rapidly our energy needs. And so Silicon Ranch Corporation has been able to tap into that and to develop power, i.e. from the solar farms, quite attractively. In addition, it's served its communities really well, partnered with local farmers, but it's wonderful to see this company is 80x the size where we started in 2014 and is continuing to grow rapidly.
Wow, that's amazing. I got a lot to get through here, so I want to make sure. So let me ask you about Alberta Power Lines.
Oh, yeah. So
this is one in the infrastructure side.
That's right. So 500-kilometer power line ends at Fort McMurray, and not only is that essential for the province, but it's really meaningful because we've been able to involve Indigenous communities in a real way. So not only do we provide scholarships to community members, and when I say members, I mean people in high school to help them go to post-secondary education, but we have Indigenous organizations that are co-owners, own 40% of the power line alongside with us. 3 board seats are filled by representatives from the community. And so this notion of economic empowerment, we're able to accomplish that while still generating what we believe to be very attractive returns for our investors.
Yeah.
So
and
very,
for
very
the communities
meaningful.
that you're involved with too. Yeah.
Absolutely.
Yeah. Okay. We'll put infrastructure aside and let's talk about real estate. And maybe just tell me at a high level, like what are the kinds of things you look for in the real estate front? And then we've got a bunch of examples. I want to run some really interesting ones that you hold.
Yeah, we really look at high quality real estate. So what do we mean by high quality? Well, I'm sure you've heard the phrase location, location, location. Well,
Yeah.
that's there's a degree of truth in that.
Yeah.
There is a high demand for easily accessible places, which in the city means places that are really close to transit. And so we look for that. We look for quality in terms of our buildings. So we don't want our tenants, our clients to come into a building and feel worn down. It's a derelict building. There are shops closed in the shopping mall, or there's entire floors in the office
Yeah.
building that are bare, et cetera. It's just not a great place to be, and it means low demand. And if you think about economic expansion and economic recession, demand maintains for highest quality in economic recessions and goes away for the lowest quality in economic
And that's what
recessions.
seems to grab the headlines, right? We see
Exactly.
what we've seen during COVID and past, where it's the real
That's
estate
right.
that gets hammered on this. So.
Yeah, and the cause is unique, right? We had global financial crisis, we had the dot-com boom, we had 9/11, we had COVID, et cetera. But what happens repeats. And so there's what we call a flight to quality, and that's effectively it. The customers want to be in the best place, and we see this time and time and time again. So we look for quality. The whole story about bilateral, I'd repeat, for real estate, we don't like jump ball.
Yeah.
We like the ability to buy something where somebody's come to us. It's a unique process, a special situation.
Yeah.
Maybe it's a closed-ended fund that needs to dispose. And so it gives us the opportunity to buy well. We run the asset really well because at the end of the day, these are places where people live, or they work in an office tower, or they work in the shopping mall where other people go to shop, or they are working in a warehouse. These are places where people inhabit. And so running places that are attractive is important, which means they're cleaned well.
Yeah.
We are repairing the roofs and repairing the
You're
windows.
taking care of the asset. Right?
Exactly.
Yeah.
And by virtue of doing a good job,
Yeah.
we get rewarded by growth in income.
Let's talk about examples. The first one I have here is for people who are in Toronto, the Royal York Hotel.
Yeah.
I'll let you drink. You can take it. It's okay.
So the Royal York is fun. It is over 1,300 rooms,
Yeah.
1,500 staff. It is a large hotel. It is right on Front Street
Yeah.
in Toronto, in between Bay and York.
Across from Union Station.
And I describe it that way because location, location, location.
Yeah.
It is a preeminently located hotel in the city of Toronto. And that's why we own it. In addition, we've been able to renovate it. So if you went into the Royal York about 10 years ago, it would be a wonderful hotel, a historic hotel. If you go in today, it's a place where people are taking Instagram shots in front of the clockwork. It's a place where if it's Valentine's Day, there's going to be a giant Valentine's Day installation.
Yeah.
It is an animated place. We put money in as well to decarbonize. So it's the first zero carbon hotel in North America that attracts not just people to stay in the hotel, but conventions, banquets, weddings. That's really huge in terms of the revenue profile for a hotel. And then if you've had anything in one of the restaurants, you'll know that the whole experience has changed. And we
Yeah.
had 3 of them on the ground floor. And as a result, harder to get a reservation. My apologies.
Yeah. It's true.
But the revenue has grown magnificently
Yeah.
as a result. And so I love that hotel because it's an example of something that is really well located. We've invested in it. The quality's gone up.
Yeah.
And we've seen the outcomes.
The next one we have here is Wilkinson Industrial. So this is in Canada, and I'll give a little primer, and you can jump in. But Canada's first net zero industrial warehouse.
Yes.
Interesting.
Yeah, because people used to think that nobody's going to really want to have a net zero warehouse because it's a warehouse.
Yeah.
But we found and proved out that you can actually build a net zero warehouse at an attractive basis. And not just that, it's actually more efficient to run. Because if you seal all what's called the dock doors, so the loading doors where the trucks come in, and these doors open and the truck's materials get offloaded.
Yeah.
They come down, the truck goes away. But guess what? Many places it's not fully sealed. So if it's really cold, all that heat in the warehouse goes out.
Yeah.
Your workers are colder. So if you seal that, not just do you save on energy costs,
Yeah.
and
Retain
you get
more
closer
people.
to zero. Yeah, it's a better working environment.
Yeah.
If you have lights in a warehouse, but what about natural light? Right? Many places where you live, you might have sunlight in your home. So why not create that in the warehouse? So we are able to do that, plus a few other innovations, and accomplish net zero, create a better working environment, reduce the operating costs.
That's fascinating. Every one is worth like an hour. New Wembley Stadium Apartments.
Yeah, so Wembley Stadium,
Yeah,
if
yeah.
you think of London, very historic.
Yeah.
New Wembley Stadium, also very historic. 80,000 seating football or soccer
Yeah.
stadium where the Olympic Games were played, etc. Connected to tube, to overground train, able to get to central London less than 20 minutes. It is an icon in London. And so we were able to buy 2 apartment buildings right beside that stadium in an area, that whole area is being completely regenerated. And when you walk that area, it's alive. There are thousands of people that are going to schools in that area, that are working in that area, that are playing in that area, that are living in that area. And it is absolutely magnificent to see. And that's just on a day when nothing's happening at the stadium.
Yeah.
And so we were able to buy into that because we bought into it in COVID, where there was low demand for these assets. The UK had repriced. We had the Prime Minister, Liz Truss, and had put together a budget. It wasn't received really well, and people were just not in a great space.
Yeah.
And so therefore, for us, that's a great space.
Yeah.
Because that represents the opportunity to acquire at a great basis. So we did. And we've achieved really good outcomes in the last 2 years because of that great basis. And then we've been running that property really well. And the area, we're right beside an icon in London.
That's great timing and great work on your team and in discovering that too. A Germany grocery portfolio. So
Yes.
this is 3 grocery store locations.
Yeah.
Tell me about this one and what's compelling.
So almost a trick question. Some of the largest companies in the world are German grocers. So they employ hundreds of thousands of people, it's really incredible.
Yep.
Owned by families. And Germany's unique because most of the population does not live in its 7 largest cities. So roughly 82% of the population lives outside of the 7 largest cities in Germany, the Berlins, the Munichs, Hamburgs, etc. And so in these communities, the grocery store is essential. And people go to the grocery store 3 to 4 times a week. And so, however, investors weren't really that focused on grocery stores. And so therefore you have this dynamic of essential asset in high demand from its customers, but investors not really that focused on it, which for us meant the opportunity to buy an asset at great basis, producing very good income, and we're able to get in Germany at a great basis.
It really does give a good purview, just like where you're looking, in terms of in the world, in terms of the assets that are being held. Okay, we've got commercial mortgages. Maybe we start with the places, and you can tell me kind of more the rigor that goes with it. Bay Adelaide. And this is in Toronto again.
Bay Adelaide in
Yeah.
Toronto, exactly. And Bay Adelaide centers 3 office towers.
Yeah.
And we've been privileged to be the mortgage provider on all 3. And very, very high quality, 3 million square feet of space. Tremendous space. To give you a sense, there are some cities in Canada whose entire office complement for the city is 3 million square feet.
Wow.
So this is a very substantial real estate, over 95% leased. High quality, we call it AAA. LEED Platinum, which means very environmentally efficient. And so our ability to operate, not just at the 5 million mortgage level, which we do $5 million mortgages, but at the $200, $300 million mortgage level, allows us the flexibility to get access to some of the best properties in our country. So we're very happy by that. On the Bay Adelaide portfolio.
Oak Ridge, where's this?
Yeah, so that's in Vancouver, and that
Yeah.
will really be a destination-defining community, really, in Vancouver. So it was a shopping mall. When you fly into Vancouver and you're just about to land, I'd encourage you just to look to the north. I say it like that because this development, you'll see it, it's a sea of cranes right now. And it is, when it's done, it will be millions of square feet, many towers, again, where people live, where they work, and where they play. It is some of the most beautiful real estate that you will see, and certainly in Vancouver. And so, again, we're able to be involved with BCIMC. So BCIMC is hundreds of billions.
Yeah.
In terms of, it's the British Columbia
Yep.
Investment Management Corporation, a very high-quality borrower. And we're doing this at, I believe, just beneath 40% loan to construction cost. And so lower risk, very high-quality borrower in a development that will be a defining portion of the city of Vancouver.
You must be on a plane all the time. You and your team just travel. Because, I mean, this is right. It's due diligence. You're out there, you're doing it, you're finding, and I mean,
That's right.
And I just, for people who can't see, I mean, there's nothing in front of you. You know these things inside and backwards. So that's why I'm like, I know that you know this. So, private credit and debt.
Yeah.
And maybe a bit of a primer on this before we
Yeah.
talk about the debt and the credit that you hold.
Yeah, so as I mentioned, it's as old as civilization.
Yeah.
But certainly very much in the news today. And it's really simple at the end of the day. As a creditor, you want to look at loan to value or loan to cost. You want to look at debt service coverage ratio. Now, what are we lending to? We're lending to private corporates. So these are companies that are just not publicly traded. We're lending to infrastructure investors who own different assets and
Yeah.
need to put debt. We're lending to real estate investors. We do credit tenant leases. So what is that? That is a space like an office that might be fully leased for a long period of time by, let's say, a major company that may be public or privately traded. We look very closely at the credit of that company because how that company does will really drive some of the value of that real estate, which then drives how we look at the risk of the loan.
Right.
We look at natural resources. We do private-public partnerships. So there are major transit developments, both in Canada and outside Canada, that we've either participated in, are participating in, or have looked at as well. So it is an exciting, very broad, very diverse space.
I'll ask you this next question later as I think about it, but just to name some we know of, like Heathrow. I think
Yeah.
everyone knows. So tell me, but how do you participate in Heathrow?
Yeah, so Heathrow Airport, as we know, it's the busiest airport in Europe, over 80 million passengers a year. And like any other entity, they do all sorts of things. So there's an operational component, but there's significant capital expenditures that are required either to attract airlines, to expand the airport, to reinvest in facilities like terminals, but also airside, et cetera. And so they require debt, and they go out to entities like us, and we provide that debt on term. And then we take a bit of a premium relative to whether it's the public markets. We call that a uniqueness premium.
Yeah.
So relative to a comparable credit quality, we will get paid just a bit more. And there's a little logic. We can move very quickly.
Yeah.
We can provide, we can be a little bit more nuanced in terms of term, for instance, payment structures, et cetera. But we will get a premium for doing
Right.
that. So we
For
call that the
accommodating their
uniqueness
needs.
premium.
Yeah,
Yes.
yeah.
And
What
so we provided just over 45 million pounds to Heathrow Airport.
Wow. CAMH, another Toronto property. People maybe this is, I think, it's known in Toronto, but it's known in Canada. It's one of the premier
Yes.
mental health facilities.
That's right. An incredible facility, I believe over 5,000 staff here on Queen Street in
Yeah.
Toronto, serving tens of thousands of patients a year. And that facility really it's similar to an airport in the sense that it operates a facility. Patients experience that facility, but also has to invest in that facility to do repairs and capital expenditures, et cetera, and also looks as the population of individuals needing their services grows, looks to grow over time to serve that growing population. And so there too, They looked for credit because they aren't publicly traded. They're funded principally through the government of Ontario, and so they're in our universe. And to help their operational needs and their expansion needs, they look for private credit entities to provide them with that capital. And so we've been able to be fortunate to participate there as well.
It's so interesting too, because you must have such a finger on the pulse of, we talk about the economy and this kind of broad, like there's not one there's many economies and many, and you would just see so much. And I imagine just the information, the relationships you have is very self-reinforcing in terms of as you build, the more you hear, the more you know, and you continue, right?
It's fun. It's absolutely fun because of that dynamic. So if you think about everything that we've covered, we've talked about hotels, we talked about airports, we talked about hospital, we talked about major office centers, we've talked about them in the UK, we've talked about them in Germany, we talked about them in Canada. We invest in over 20 countries, over 4 continents, covering over 150 cities across all of these different sectors. And in every single one, yes, there's the macroeconomy, right? So what's tariffs going to do? What's inflation going to do? What's the different central banks going to do? How's GDP growth going to look? But then, yes, there is the microeconomy. So a country might not do well, a city might still do well. Then you have the sector. The city might do well, but the sector might not. Or the city might not do well, but the demand for a hospital grows. And so that level of, call it creativity, that level of curiosity, that level of excitement, because every day something else happens, is really important. However, having said all of that, perspective really matters.
Meaning?
Meaning, every day something happens in the world. The question is, does that something fundamentally change the attractiveness of what we do, what we invest in, how we manage, and how we look to dispose?
And there's a lot going on in the world right now.
So a lot of the focus then is, what is noise in the context of useful to know, but not really going to fundamentally change things, versus something that, hey, it's starting, this might actually fundamentally change things. So if you think about the last 6 years, COVID is one of those.
Yeah.
And in Jan 2020, certainly I was getting updates on what was happening in Wuhan, partially because we had exposure in China. And that was something that clearly had big impact in the world. Well, so did the inflation dynamic. And that dramatically changed how one looked at valuing assets. Population changes. So immigration policy change, another one that fundamentally changes not just the residential space, but might also change assets that depend on how many people use them every single day. Versus tariffs might go up on a particular sector from X to Y. Well, tariffs might go up. We have to look at the probability that they do.
Yeah.
If they do, at what point do they do? And then what is the impact? Or there's a tax credit to build renewable. Okay, when does it expire?
What would the next government want to do?
But also, does this renewable energy work without the tax credit? Increasingly, we find the answer is yes.
Yes.
Because the demand for energy is so profound and is growing so quickly.
Yeah, that we can't satisfy it in other ways, yeah.
Exactly. So some examples of how, and it's not just me, and that's really critical, we don't believe in a star culture. We believe in team.
And this is at TD Asset Management, yeah.
We believe in the full team being involved in our investment committees, which means that every week we have over 90 people looking, analyzing, discussing. And then we believe in the obligation to dissent.
I was going to ask you that. I think, explain a bit, I think it is self-explanatory in what you say, but give me an example of that.
Yeah, it's really hard. It is self-explanatory, but it's really hard to do, which is in the land of heavy personalities that the private markets are, many founders that have created big companies believe in those companies. Somebody that has just joined might have 3 months of experience. They've read through the package, they've done some research, and they disagree. It is their obligation to challenge that entrepreneurial founder, that CEO, the head of the committee, the chair that's been around for a decade or 2 decades. It is their obligation to say, I disagree. The beauty of an investment team is you have people with many perspectives, and they feel comfortable to bring those perspectives to the table, to voice, to raise, to discuss. That's really critical.
Let me ask you this last question. It's going to be, what have we not talked about that you think people need to know as they think about this world? What are you excited about? What are you worried about? Like the space as things evolve.
There's a lot of headlines. Office is dead. Shopping malls are dead. Private credit is 2 steps away from global financial crisis land, etc.
Yeah.
I could go on. And it can be very paralyzing. And my encouragement is to step back and to say foundationally, what do these assets do? How do they perform in good and not good periods? Meaning, do they generate income? And at the end of the day, doesn't matter what you invest in, income is the driver of value. And the ability to grow income is the driver of your ability to grow value. Foundationally, it's as simple as that. And so what I'm excited about, I'm excited because if we think just simply like that, energy, we need more of it, tons more of it. The likelihood that we're able to generate growth in income is high. Mm-hmm. Governments don't have money, enough of it, to do everything that growing societies need. That means high demand. Mm-hmm. We need more spaces to live in. Virtually every major developed city talks about a housing crisis in one way or another. And so the ability to invest in solutions that will actually help solve these major issues, but more foundationally are able to grow income because, quite simply, lots of demand, limited supply. And then you layer on top the ability for individual investors to get access to this in ways that have not existed before. Yeah, that's really exciting. But don't get paralyzed by the headlines.
Yep.
Do the due diligence, do the work, recognize there's powerful personalities and big personalities, so you do need to do the work.
Yep.
But if you do that, the ability to actually amplify portfolio performance is exciting, and that's meaningful because obviously that means that families are in a better spot, people can retire in a better spot, they can do things that they didn't think they could do. That's what makes me excited.
Well, it was great having you here, and I have to say, what an absolutely thorough primer this was. Thank you for investing the time with me to do that, because I know it's a lot, so thanks very much, Colin.
Thanks for having me.
Thanks for tuning in to this episode of the Money Talk Podcast, brought to you by TD Wealth, recorded on February 25th, 2026. The information contained herein has been provided by TD Wealth and is for information purposes only. The information has been drawn from sources believed to be reliable. The information does not provide financial, legal, tax, or investment advice. Particular investment, tax, or trading strategies should be evaluated relative to each individual's objectives and risk tolerance. The views expressed are those of Colin Lynch, Managing Director and Head of Alternative Investments, TD Asset Management, as of February 25th, 2026, and are subject to change based on market and other conditions. Certain statements in this presentation may contain forward-looking statements that are predictive in nature and may include words such as expects, anticipates, intends, believes, estimates, and similar forward-looking expressions or negative versions thereof. Forward-looking statements are based on current expectations and projections about future general economic, political, and relevant market factors, such as interest and foreign exchange rates, equity and capital markets, the general business environment, assuming no changes to tax or other laws or government regulation or catastrophic events. Expectations and projections about future events are inherently subject to risks and uncertainties which may be unforeseeable. Such expectations and projections may be incorrect in the future. Forward-looking statements are not guarantees of future performance. Actual events could differ materially from those expressed or implied in any forward-looking statements. A number of important factors, including those factors set out above, can contribute to these digressions. You should avoid placing any reliance on forward-looking statements. Information about specific companies or securities, including whether they are profitable or not, is provided for discussion purposes only and is not endorsed by TD Wealth, the Toronto-Dominion Bank, or its affiliates and related entities. Any reference to a specific company listed herein does not constitute a recommendation to buy, sell, or hold securities of such company, nor does it constitute a recommendation to invest directly in any such company. TD Wealth represents the products and services offered by TD Waterhouse Canada, TD Wealth Private Banking, offered by the Toronto-Dominion Bank, and TD Wealth Private Trust, offered by the Canada Trust Company. TD Asset Management is a wholly owned subsidiary of the Toronto-Dominion Bank. The TD logo and other TD trademarks are the property of the Toronto-Dominion Bank or its subsidiaries.